If you want to invest in the stock market, index investing is a good place to start learning about investing in the stock market. There are 4 questions that you need to answer to understand index investing. First, what are you investing in? If you buy stocks, you become a partial owner of a company. And why do you expect your investment to grow in value? It's because these companies provide products and services, and these companies get paid for these products and services, so they generate a profit, and the company uses that profit to pay you a dividend, but also it uses the profit to reinvest back into the business so that the business can grow. So what is the expected return of investing in the stock market? If you look at the 100-year history of global stocks, the average return is between 6 and 10%. If you calculate your financial goals and you want to invest in the stock market, you could use 6% as a conservative measure or 8%, which is also realistic, but you can also use 10%, but that's quite ambitious. So what are the risks and how to mitigate them? There are 2 different risks, default risk and timing risk. Default risk means that if you invest in a company and the company goes bankrupt, you lose your money. So how to prevent that is that you invest not in one company, but you invest in an index, for instance in a global index, which consists of 1,500 companies. And then if one company goes bankrupt, you won't even feel it. Timing risk, because the market goes up and down, the moment that you go into the market and go out of the market is very important. So how to prevent timing risk? First of all, you can invest with a long-term horizon in mind. Invest as if you're never going to sell. Also, you can invest periodically, and we will go into that in more detail later. Also, that's easier to automate. And if you divest, you can also do that periodically. There are 2 rules that you can use. The rule of 7 and the rule of 4%. The rule of 7 means that by the time you want to have your money, you make sure that you have 7 years of income available in case the market is down and you don't want to sell. And by having 7 years of income available, you're not forced to sell. Or the rule of 4%, meaning that if you withdraw 4% from your total amount that you have invested, that would mean that in most cases you will have an income that will last forever. Because if you get a 6% return and you only use 4% for yourself, then your invested amount will continue to grow with 2%, which will cover inflation. So why is periodic investing so beneficial? Here an example. Let's say each month you want to invest $1,000. Let's say the index has a value of 100. In that case, you can buy 10 stocks. In the second month, you still want to make the investment of 1,000. The index price has now increased to 200. That means you can only buy 5 stocks. And in the third month, you make the same investment, but the index price has now decreased to $50. Then you've bought 20 stocks. And in the fourth month, you don't make an additional investment, but the index price has returned to $100. In month 4, you would have in total 35 stocks. And if you then calculate how much you have earned, you would have invested 3,000 over the 3 months, but your investment has grown to 3,500. So your return is $500. That's 17%. So how come did you earn money while the price stayed the same? It's because when the price was high, you buy less stocks, and when the price was low, you buy more stocks. The reason why people fear to invest in the stock market is because markets crash. However, market crashes are very normal, but also are a big opportunity. We make the distinction between a correction and a crash. A correction is a stock market decline of between 10 and 20%. A crash is a stock market decline of over 20%. If you look at the history of, for instance, the US stock market, you see that corrections and crashes are very normal, but they also are temporary. A correction happens every year, and the length of the correction is between 0 and 3 months. and a crash is every 3 to 5 years. But also crashes don't last forever. The average crash lasts between 2 months and 2 years. So why is a market crash such a big opportunity? Let me show you. Let's say the index is worth 100 and you get a market crash of 50%. The index price goes to 50. And let's say the market recovers and the index price goes to 100 again. What is the increase? The increase is 100%. Why? Because the increase from 50 to 100 is $50 and $50 over $50 is 100%. So if the market crashes 50% and recovers, you can double your money. So why would the market always recover? That's because the economy always grows. The number of people continue to increase. When you have more people, there is more consumption. And when there's more consumption, companies earn more money. And that means that global stock prices always go higher. If you look at the US economy, which is currently an important driver of the global economy, and you look back over the last 50 years, you see that the economy has always grown with the exception of a few years. And if you then look at how the US stock market performed, you see that it goes up and it goes down, but the trend is upwards. Another reason why the market has a positive tilt is that if a company goes bankrupt, you lose 100% of your value. But if a company does well, the stock price can go up 100%, but it can also go up 200%, 500%. There's no limit. So the average of the market is likely to be higher. The last investment question that we need to answer is how much will it cost to invest in an index product? The average cost of an equity product is currently between 0.2% and 2%. The costs of an equity index product are significantly lower, between 0.2% and 0.5%, depending on the index and depending on the provider. Next to product costs, you also have other fees that you need to take into account. You will have broker costs, also called service costs. You will have transaction costs, and you will have fees that you pay to your financial advisor if you use one. Why are fees so important? Because fees will have a significant impact on your end result of your investment. Let me show you why. For example, if you would invest $1 today for 50 years, and if you get an 8% return, your $1 will become $47 after 50 years. So your dollar has multiplied 47 times. But what if you have a 2% fee? Then your return is not 8% but 6%. And in that case, your $1 would become just $18 after 50 years, meaning that you miss out 62% of your value. That's why it's important to know what fees you are paying. So how to apply? If you want to buy an index product, you can buy either an index fund or an ETF. And here's some characteristics. They both track an index. However, there are some differences, like when they're trading and how they express their costs. And the names are different, so that you can see what you are buying. If you have the ambition to invest in an equity index, I would like to challenge you to rewatch this video until you can explain the content of the video to your friends. Put down in the comments below what other type of investments you would like to see discussed on this channel. If you like this video, please like and subscribe to my YouTube channel for more videos on money principles.